So welcome back to Unit 3 now, guys. Obviously, I hope you've got all your charts set up nicely now. You're kind of starting to grasp the basic settings of the footprint chart and enjoying that trial of yours. So obviously, this is Unit 3. This is Challenge Day 4 of 30. This is a two-part series, both Part A and B. So just a few little tips and things to take note of. First things first, all the principles that we're going to speak about over the next couple of slides, they predominantly applied within the cash hours, okay? And the reason being, remember, the footprint tool is a tool for interaction between buyers and sellers. Now, outside of the cash areas, it's not to say that there isn't, buyers and sellers. However, the type of participants is very different to what you'll see when we have the cash hours. So for us, we're more focused on the interaction within the cash hours. So just to basically summarize that in terms of obviously the currency space, that'll be roughly around 8 a.m. GMT, and that'll last all the way up until around 4 o'clock p.m. GMT, which is the fixing. In terms of the WTI oil, that'll be around 1:30 p.m. GMT, and that'll run all the way up until 7:30 GMT. In terms of the E-mini S&Ps, very straightforward, 2:30 p.m. GMT until until 9 p.m. GMT, and lastly the gold COMEX, again roughly 1:30 up until the 7:30 p.m. So again, the important thing to understand is those are the time frames within which you're likely to find the types of participants that are going to show the kind of interaction that we're going to speak about within this principle-based unit. Okay, now note, so important, guys, principles are not an exact science, okay? This is not a signal course. This is not a course about me saying to you, when it does this, you buy here and you put a stop here. Okay, that's pretty much, it was a fallacy sold to traders back in the day. People wanted an exact approach. We are discretionary traders. We trade principles based on discretion. By that very definition, there is no exact science, and because of that, we always need to manage risk, okay? It doesn't matter, I'm going to share with you a lot of rules of thumb, and it doesn't matter if the setup, you're so confident in that setup. We always have to manage risk, okay? It doesn't matter how confident or how high the probability of success is. We always have to manage the risk at the end of the day. Okay, then we're going to talk, the most important thing is, how do you adopt these principles? How do you get better at these principles? And now, unfortunately, it's like everything in life, any skill, it's going to come through a lot of observation and most importantly, a lot of practice. Okay, so if you want to understand these, these principles a lot better, just adopt them to the live markets. And over time, you're going to learn and understand them a lot better. Okay, and then obviously do note, I am going to share with you quite a few rules of thumb, but bear in mind they are generalizations. Okay, so it's not a hard fast. It's not a if X does this, then you do Y. Okay, it's not as straightforward as that. But those rules of thumb, they are high probability rules of thumb. So do jot them down and keep them in your journal. Okay, and then lastly, do note each principle can be best seen in various strategies. Okay, so what I'm going to share with you as I go through each principle is I'm going to highlight for you where, in which strategy over the next couple of units that you're most likely to pick up on that principle. Now, the reason I've done this is simple. As you're going through the strategies, what you can do is you can come back to this unit and view the different, principles that are adopted within that strategy, and hopefully that will highlight the key elements of the strategies that we're going to focus on. Okay, guys, so that being said, let's get straight into it then. Now, first thing is, the first principle we want to talk about is a strong and weak auction process. Okay, so very simply, an auction process is where buyers and sellers are interacting with one another. Buyers will obviously, in theory, interact when prices are at a discount price, and sellers will interact, in theory, when prices are at a premium price. Now, anything in between, markets in theory are fairly balanced. Okay, so anywhere within this, we are reaching a fair price or a balanced market. Okay, now obviously the basic assumption is markets will very quickly move away from discount and equally very quickly navigate away from premium prices. Okay, bear in mind obviously the basic premise of the market, or the markets were created in order to facilitate trade. So between where discount prices and buyers will be, and between buyer or sellers at premium prices, the market will oscillate and facilitate the trade. Okay, so obviously one of the most important things that we look at in terms of rotations and processes is this interaction. Okay, it's all about interaction. That's what the footprint is all about. So what we're going to learn about, and I will talk about this quite extensively in a couple of slides time, is this concept of initiative and responsive. So very simply, initiative is simply where a buyer or a seller steps into the market, initiates trade in a one-directional manner, in an aggressive type of manner. Now that's initiative. What then happens is, as markets initiate in an auction, they then bring in responsive type participants. In other words, if prices move from a discount and they move up to, say, a fairer value, we will then see a responsive action taken by a participant that deems this as fair value. Okay, so they're responding to the higher price, or responding to the auction of higher prices. Okay, so it's simply that interaction, this navigation between initiative and responsive. That's what we're going to talk about quite extensively over the next couple of slides. Okay, one of the things we do look at when we talk about the auction process is the type of overlap. Okay, this is quite crucial. Overlap simply means, if I show you on the chart, on the left side we can see almost a full overlap, 100% overlap between rotations, whereas in the latter part of the chart we can see a lot less overlap. Now, stronger auctions, okay, tend to have less rotational overlap, whereas weaker auctions tend to have a lot more overlap. Okay, then obviously in terms of strong and weak auctions, very strong auctions tend to show something called one time framing. Now again, in the example, what we'll see is where we have rotations that cannot take out the previous low of a rotation. That is what we call one time framing. Now a very strong auction process will show this and exhibit this type of one time framing, whereas a weaker auction very rarely, or will never show it, in fact. Okay, then in terms of the another one of the key comparisons between strong and weak auctions is the delta. Okay, and this is crucial. So what you're going to see in a weak auction, again, if I can illustrate it with the first half of this chart, is you're going to see the delta remain relatively muted. So no real net change in the delta, showing us that there's no real initiative being taken from buyers or sellers. Okay, so as we mentioned, when there's a strong auction, i.e. we're seeing initiative being taken and we're seeing a positive delta response. When there's a weak auction and more responsive type trade, as we can see on the left side of the chart, then the delta barely moves. Okay, in terms of volume, it's very similar. Okay, when we do have a very strong auction, we do tend to see a higher, or at least a pickup in the volume. Okay, it's very important as a general rule of thumb. What you want to see is, when we have a strong auction and we have some real initiative being taken, we also want to see a relative pickup in the volume as well, and we can see that relative pickup compared to what we've seen in previous weaker auction. Okay, so where you can apply this strategy, or where this is going to be applied to down the line, it's very simple. We're going to see a lot of this concept of strong and weak auctions when we talk about the absorption and auctioning strategy, as well as the initiative drive strategy and the failed break of support and resistance strategy. Okay, so that's our first principle discussed. Let's now have a look at another important principle. Trend. Okay, something we talk about, a word we throw around quite a lot. The markets are trending. Did you see that trend today? But what in fact is a trend, and how do we identify a trend? Now, what you're going to notice over all these slides is that I'm not going to merely just state a trend is something. Okay, I'm going to show you the objective facts from the market so that you can learn to identify trend on facts rather than opinion. Okay, so what is trend? Well, the first thing is it's very much directional bias. Okay, so you look at a market, as you can see on the chart, and there's a general directional bias in the market. So it's moving in one direction and can be easily observed. Okay, the second thing, one-time auctioning. Again, we mentioned one-time framing. So one-time auctioning, again, is well, it's the exact same concept where we cannot take out the previous high in this example of a rotation. Okay, now to just include in terms of that in that auctioning process, when we have trend, we are exhibiting a very strong auction process. Where the market is moving and navigating in one direction quite aggressively. In other words, there's quite a lot of control, and I think that's a key word, to almost highlight is, trend is nothing more than control. Okay, it's one side, whether it's buyers or sellers, in control of the market and the direction of price. Okay, now obviously in terms of trend, what we do tend to see is we can see it in both low and high liquidity conditions. Okay, we will talk about the concept of liquidity later on in this unit, but so important. You can see trend in low and high liquidity. Okay, a mistake people make, they tend to think that when markets are trending, there's low liquidity. Okay, that isn't the case. You can see trend in both high and low liquidity markets. Okay, now one of the key characteristics you tend to find when a market is trending, and this is something that I learned very early in my career, it's something we call shallow pullbacks. Okay, so what does that mean? Now again, I know I've obviously got the footprint in front of us, but what a shallow pullback is in essence, we can see if this is one candle, ultimately the market, it fails to sustain any kind of hold within that previous rotation. Okay, so it's really shallow as opposed to something like this. Okay, it's almost like if we were to put a percentage on a fib retracement or something, maybe like a 38.2%. Okay, so the market's unable to retrace even 38.2% of the previous rotation. Okay, now again, this, shallow is a really relative term, but what you can see very clearly in this example is as this market's going down, it's really failing to get any meaningful, kind of bid into the previous rotation. I mean, we can see in this example right here, it pretty much opens, so it closes on the low, and the very next candle opens on the low and sells off again. Okay, so that's one of the key proponents of trend. It's really shallow pullbacks, and the purpose of that, and this is what's so important about the footprint, is that the interaction, i.e., when we have a shallow pullback, it's showing us the aggressive nature of the interaction between the buyers and sellers. In other words, it's not allowing any participants in. So as this market is rising and coming back, sellers are so aggressive, they're so intentional that they're willing to hit at very, very extreme prices. Okay, now one of the key rules of thumb again is that if a market is not allowing participants in, by that very nature, participants are thus being forced to be aggressive in nature. In other words, if the market won't allow them a passive entry, it means that anyone wanting to sell needs to be aggressive rather. In other words, they need to hit the market. Okay, and that's why when we do see trend, we tend to see trend continue for longer and longer and longer. Why? Because participants are desperately trying to get in, and unfortunately they have to go to the market rather than wait for the market to come to them. Okay, then another key sort of like a mantra I like to quote is it's sort of like a drive, absorb, drive, absorb. That's what the pattern of trend looks like. Now, again, you can see this on the footprint, but I'm going to illustrate it for you first. So what it looks like simply is you get the initial drive, and okay, so you get the initial drive. The market then has a shallow pullback, and we get this sort of accumulation phase, okay, also known as responsive price action. So we get the initiative, then we get the responsive, then we get the initiative again, and responsive and initiative. So like I said, it's drive, absorb, and this pattern continues almost for an entire session, in very good trending markets. Now, if we were to look at that on the footprint, again, you can see it here. Sort of, we get the market selling off. We then get the absorption. Okay, you can see the dark shades. We then get the continuation, and again, the darker shades. We then get the continuation, and again, the darker shades, and continuation, and darker shades. Okay, so the light shades are showing us the initiative, and then the darker shades are showing the absorption before we then get the continuation again. Alright, now one of the key tools you can use, and this is where I do think moving averages are particularly good, is a study that you can add to your footprint or your candlesticks, is a moving average. Okay, you should all know this by now, but a moving average does represent lagging information. However, it does keep us on the right side of trend, or at least if we're not seeing the trend clearly and not picking up on the characteristics that I'm showing you, it sort of prompts us to recognize the fact that there is very strong price direction. Now, it's very simple. In terms of a moving average, the slope effectively reflects the nature of the trend. So a steeper slope reflects a stronger trend, whereas a shallower slope obviously reflects maybe not as strong as a trend. Okay, then if we talk about the next characteristic, and this is again a lovely little rule of thumb, and I've got a nice expression for this. Let's go over this point first. So like I said earlier, an aggressive entry reduces the risk. So in this strategy, okay, and we're going to talk a lot about trend strategies when we talk about initiative, but in this strategy, ultimately, by being aggressive, okay, so being an aggressive trader in a trending market, you're actually reducing your risk. Okay, why? Well, because what a lot of traders tend to do, and what they make a really big mistake in trending markets, is they're not willing to get in on this area. Okay, what they're waiting for is they're really hoping and waiting for that pullback. Now, remember what I said: trend is created because participants are forced to execute aggressively. Okay, in other words, the market's trending simply because no one is being allowed to enter the market on a pullback or passively. Alright, so by that very definition, if no one is being allowed into the trend, then waiting for the market to pull back comes with its own set of risks. In other words, that might be the end of the actual initiative or trend, okay? And that's why it's a lot better, and the risk is reduced to simply be aggressive when there is trend in the market versus being passive. Okay, now the next thing, and it's a lovely mantra I've got, it takes time for the tide to turn. Okay, this is something, again, through failure, through losing a lot of money in trend days. I used to be particularly bad at them. What I finally learned was there does come a point where a trend can be faded, and we will talk about strategies where you can potentially look to fade trend. However, as a rule of thumb, remember, just like it takes time for a tide to turn, it also takes time for a big ship to turn. Okay, so if this is the big ship, once it turns, it's not going to turn in a straight line in reverse, okay? It's likely going to spend a lot of time turning slowly, and then maybe move up. So just bear that in mind, guys. If you want to fade trend, you have to acknowledge the fact that it does take time for trends to turn around. Okay, now, what I would say, when there is trend in the market, when you're seeing these characteristics, i.e. shallow pullbacks, influential majority, etc., just make sure, that you're not entertaining the fade just for the sake of wanting to trade, okay? One of the mistakes a lot of younger traders make, particularly when they have fewer markets to focus on, is they feel the urge or the need that they have to trade. Okay, what you don't have to do is you don't have to stand in the way of a falling knife. Okay, and that's where you have to be careful with trends. All right, if you're not going to get on the trend and take the right or the high probability trade, don't stand against it just simply for the sake of trading. Okay, now, what I would say, when it comes to the exhaustion point, some of the key factors you can look at will be things like time, volume, and range expansion. As a brief example, what I will show you, and we will talk about this when we talk about the exhaustion strategy, but ultimately trends do tend to end when we have the most volatility. So again, a rule of thumb, the most volatility, i.e. you can see the biggest rotation tends to cap off the bottom of this trend, and we then start to get a slow turnaround. So what we do typically see is the exhaustion point does come with a very high volume. It does come with a much higher delta relative, and obviously it does happen in a relatively quick space of time. Okay, what I would say, one of the important proponents or components of any trend is time. Okay, the reason being is that, obviously when there's trend in the market, participants that are shorting here and shorting here and shorting here, they also need to be paid for those trades. So the longer the market were to say spend time in a sideways range, the more vulnerable those aggressive shorts become. Okay, so time does play a key proponent in a trend. Obviously, the longer a market is unable to continue the process of trending, the higher the probability becomes for the end of that trend. Okay, so where you'll see this and where we're going to start talking quite a lot about trend in terms of strategies will be again the absorption and auctioning strategy. We'll talk about it in auction imbalances as well as exhaustion high and low strategy, the initiative drive strategy, the breakout trading strategy, and risk event trading. So again, as you can see, we're going to be utilizing this principle of trend in most of the trade strategies. Okay, let's move on to the next principle. Consolidation. Very simply put, as the picture says, markets are consolidating. In other words, there's a lack of directional bias. Okay, there's neither here nor there interest from the buyers or sellers. All right, there's no initiative. No one wants to take the initiative to drive prices up or down. So we see an exhibit of a lot of two-way trade. Now, again, there's complete overlap. As you can see in the example, we can see these rotations are all 100% almost overlapping one another. Okay, in terms of some of the key metrics you can pay attention to, a very neutral delta. Okay, so if you see the markets moving sideways, yet the delta is really not moving at all, there's no real interest from the delta, that's a really early sign in terms of a real consolidating market. Now, again, the reason we learn to identify things like trend or consolidation is because certain strategies are going to work well when the markets are trending, and certain strategies are not going to work well when the markets are consolidating. Okay, so it's about being able to differentiate between the two and apply yourself accordingly. All right, now do note, obviously, I'm going to throw around words like a neutral delta or, a lower relative volume. Just remember, everything with the footprint tool is in relative terms. Okay, so it's all good and me well saying, well, 107 is low delta, okay, but it must be low delta relative to what we've seen in this market. Okay, and that's the key, guys. Remember, everything is relative. Whether it's volume, whether it's delta, whether it's time, it's all relative terms. Okay, so again, in terms of consolidation, we're also likely to see lower relative volume. And again, just remember with the footprint tool, if you didn't pick up on this in the Unit 2, we will talk a lot about this in Unit, obviously the rest of this unit, when we talk about color shading. But do bear in mind, obviously, that just like the prices, in fact, let's quickly go over that again. We do have obviously our shading. I will talk about this at the end of the unit again, guys, but just to bring you up to speed. Okay, in terms of shading, we do have red and blue. And again, just to bring you up to speed, the blue is where the buying delta is effectively higher than the selling delta, and the red is where the selling delta is effectively higher than the buying. Okay, now in terms of that, we're going to have three shades on each side. Okay, the lighter shades represent lower change in delta, whereas the darker shades represent higher change in delta. Now, just like that is the case in terms of the prices, it's the same thing for the FPBS tool. Okay, so the same thing, in other words, where we have darker shades, that's showing us higher relative, in this case, higher relative buying volume, and then obviously the same for the delta there. In the lighter shades, as we can see with the -9 and -5, those are the lower relative shades. Okay, so not just do we have the relative changes in the price, we also have it in the actual FPBS tool. Okay, so again, that's why I really like this tool. It's a very quick visual representation of what's going on in terms of interaction. Okay, now one of the mistakes a lot of people make, and we're going to talk a bit about this later on when we talk about absorption, there is a significant difference between the principle of consolidation versus absorption. Okay, consolidation is simply where the markets are consolidating. There's no initiative being taken on either side, low volume and low, a lot of overlap, low volume and low delta. Now, in terms of absorption, that's very different. Okay, absorption actually tends to have very high volume, Okay, it tends to have relatively high delta. And then most importantly, okay, consolidation doesn't necessarily consolidate and then move one way or the other. Okay, consolidation tends to just continue consolidating and balancing, whereas absorption, when the markets are absorbing, once they break either side, they then tend to initiate or trend in that direction. Okay, we will talk about this principle a little bit later on when we get to the absorption principle. Okay, now one of the other things, obviously, is that when we do have this consolidation, the markets can move in between this idea of initiative and responsive. So they can keep, we can initiate, then respond, then maybe initiate, then respond, initiate, respond, initiate, respond. So the markets continue this process of initiating and responding over a period of time. Okay, so where are we going to see this idea of consolidation? Well, you're going to see it pretty much in every single strategy. Okay, consolidation is just a general principle term for when the markets are moving sideways, low volume, low delta, not a great deal of interaction. Okay, so in terms of the example, what you can see in the Eurodollar FX here is again a lot of light colors. Okay, that's what you will tend to see, a lot of light colors. You'll tend to see darker colors maybe at the extreme points. You'll see just really difficult price action, i.e. no real clear trend either to the upside or downside. Okay, now the next major principle we're going to talk about, and again it's a principle I feel very important we discuss, because again I feel like this concept of support and resistance gets utilized it gets utilized extensively, but a lot of the time in the wrong manner. Okay, so what is support and resistance? Okay, to answer that question, you actually need to answer the question of what is creating an extreme point, whether at price point R or price point S. Okay, what is it that's creating that? Now, people tend to look at support as the line where you buy it and the market comes off that line and it bounces. Okay, the low or whatever it might be. Right, support is a lot more than just the low. Okay, and that's what we're going to talk about. We're going to talk about 3 different types of support and resistance. So the question you need to be able to answer is, when we get to say a resistance, is the market resisting because buyers are no longer willing to buy there? Or is it resisting because sellers want to sell there? Or is it resisting because buyers want to take profit? Okay, what is the real reason behind why the market is stopping at that point that we call resistance? Okay, so if you really want to understand support and resistance, you need to learn to understand the interaction taking place at that price point. And those are the 3 examples I'm going to show you. So one of the key things to note is the price response. Okay, that's what I'm getting at, is that real good support and resistance shows you a very unique specific price response, and I'll show you what that looks like in a minute. Okay, a lot of it has got to do with the volume structure. Okay, high volume versus low volume. And if I was to just bring it back to the basic sense, when we spoke about the auction process, remember we said that sellers will always interact aggressively when the markets get to a premium. And likewise, buyers will always interact aggressively when we get to a discount. Okay, so a lot of the time we interpret resistance as premium when it isn't. Okay, so a market may just come up here, we see the buyers take profits, but we still call that a premium price because we're calling it resistance. Okay, in the case of where buyers are simply taking profits, that isn't premium prices. Okay, in the case where sellers actually do step in and initiate prices back down, that price action, that we can call premium. Why? Because sellers are stepping in to take advantage of premium prices, not buyers stepping in and taking profits. Okay, and that's the key difference that you need to learn, and that's the examples I'm going to show you. So the first one is what we call a key auction reversal. In other words, it's initiative taken from, let's say, the buyers, and the minute it gets to premium prices, we see initiative being taken from sellers. It looks a little bit like this. Okay? We call this an inverse V reversal, or in the case of where the market comes and finds buyers and buyers initiate, we call that a V reversal. Okay, now note this is the highest volume reversal, so you'll see a very high volume and volatility on this reversal. I will show this in an example. Okay, the second type of price response you can get is what we call an exhaustion high or low. In other words, the market gets to a certain price point, it's absolutely exhausted. As a result, we tend to see a response coming from sellers. Okay, and a lot of the time, that response in this example will be profit taking. Okay, now obviously this is slightly lower volume and volatility relative to the key auction reversal. Now, the third type of support and resistance is the failed break support and resistance. Okay, a lot of you call this a head fake, or you'll know it as a head fake, and very simply, it's where we're seeing a responsive type price action. Okay, now, where you're going to apply the strategy quite a lot is key auction reversals, that is towards the latter half of the course, breakout trading definitely, failed breaks of support and resistance, as well as exhaustion highs and lows. Okay, let's look at a few examples now so we can get an idea of these three different types of support and resistance points. So what I've done, again, I've just put a nice little chart here. Okay, it's nothing more than just the oil, and what we can see, again, traditionally people go and they put a line there and they say, okay, well that's support, and they put a line there and they say that's resistance. Okay, but it's a little bit more important, and this is where the footprint is so key. We want to drill into this area and this area, and we want to drill into these areas and go and have a look at, is this a discount price, or is it merely sellers taking profit? And is this a premium price, or is this genuinely where the sellers are or the buyers are taking profit? Okay, and that's the key, that's the nuance that we're looking for. Now, the first one we're going to look at is this example of a key auction reversal. Now, what it looks like on a footprint is, the first most important thing is we spoke and we said it'll be relatively high volume and volatility. Okay, now what we can see in this example is that there is quite a lot of volatility, quite a lot of range expansion. Now obviously we haven't quite got to the principle of volatility yet, but for now volatility just simply means range expansion or rotation expansion. In other words, this is a very large rotation in terms of the number of prices. Okay, now what you will typically see with key support is once we find that point where we have found some sort of a profit take, ultimately there's a very specific manner in which the market will trade, or which the footprint will trade. And again, I don't want to explain it in too much detail because we are going to cover this later on in the unit. Now, the basic premise, how it will look, you will always tend to get dark colors around the low. So really key auction reversal lows, you'll get dark colors down at the low. Why? Because it's first a response. Okay, in other words, the market is selling off quite aggressively, it's desperately searching for liquidity, and suddenly it runs into a response. Okay, these are passive buyers, market makers, whatever it may be, but the market responds to that discounted price. Right? Once it responds to that discount price, we then see buyers not just remain responsive, but also become more initiative. So they step in and they initiate trade. So that's kind of what we're seeing in the next rotation, is that initially the market absorbs and straight away buyers say, well, we want to be buying higher prices. Okay, now within this process of buying higher prices, you can still see a lot of dark shades, and all that is that as buyers are buying off the low, we still have sellers that are desperately trying to get out. Why? Because the market has quickly moved away in terms of price. So there are a lot of potential sellers caught, and they simply providing liquidity for buyers to buy up prices higher. Okay, and that's all we're seeing. We're seeing buyers simply absorbing the remaining sell-side price action. Okay, and slowly but surely, as those sellers start to get their fill, as those sellers' positions become complete, we then start to see the buyers step up the price action and continue to initiate prices higher. Now note, this initiation or this V reversal, as you spoke about, will continue. In other words, the top of the V will only come once those buyers run into, again, responsive sellers. Okay, and that's what we're ultimately seeing here. We're seeing the market at higher prices run into responsive sellers, and again, note what we see, a nice high pickup in the volume. Okay, so that's what a general V-shaped reversal will look like. Again, I will go through this a little bit later on in the unit. Now, the second example that we're going to look at is where we have more of a responsive to responsive type support and resistance. So what we can see here straight away, I'm just going to illustrate it with a nice S and an R, is we can see as market prices come down, we see that obviously the sellers have run into marginal buyers. Okay, so it's a case of the market comes down, and it's not really that sellers are maybe taking profit, it's just they're no longer willing to be aggressive at these prices. Okay, now remember, the market's job is to facilitate between buyers and sellers. Okay, so if we were to call this buyers and call this sellers, we can see that this market's doing a very good job of that. Now, in terms of when we get responsive to responsive type price action, what you're likely to see is you're likely to see dark colors at the extreme, but then the market rolls back over, and dark colors at the extreme and the market rotates back higher, and dark colors at the extreme and markets roll back lower, okay, etc., etc. Now, the key thing about this type of support and resistance is that it isn't really support and resistance, okay? It's merely just a pricing area where the market is reluctant to initiate, okay? And that's the key word, all right? In the first example, we could see that there was real, genuine buying coming in. Why? Because prices were at a relative discount. In this example, yes, the market is holding on to this price point, but it does not call it, it's not necessarily support just because the market cannot get beyond this point, right? It can be, as we see in this example, simply because sellers are not willing to initiate below this price point and buyers are not willing to initiate above this price point. Okay, now, what is key, and again, and why I want to introduce this principle now, is that what you're going to find in general terms is that, as in the first example, okay, when we do have those really key auction lows, those do act as very good longer term support and resistance, okay? Whereas in this example, these tend to act as much better breakout trade opportunities, for us. Okay, so that's the basic concept then of support and resistance. Right, now that we've discussed that, I want to talk about quite an important term in the markets, which comes from, in fact, the market profile, and it's that term of balanced versus imbalanced markets. Now, this is a crucial principle to understand simply because, by the very nature, okay, trade location, okay, the location of where price is will define the kind of volume and volatility that we're likely to see. Okay, in other words, when you come in the morning, if you're not aware of the trade location of the market, you won't be applying the most effective trade strategies to that market. Okay, and that's what balanced and imbalanced markets are all about. So, very simply, a balanced market is simply a market that is within the previous day's range. Okay, it's within the previous day's accepted value area, and we tend to see relatively low volume, low volatility, and a lot of two-way trade. So if I was to illustrate that in terms of a candlestick, if that was the previous day's range, and this is predominantly where most of the day's volume was, then all a balanced market is it's a market that's simply trading and oscillating within that previous day's balanced area. Okay, now the most important thing and the rule of thumb with regards to balanced markets is that markets, when they are balancing, they are consolidating. In other words, there's a real lack of initiative to the upside, and there's a real lack of initiative to the downside. Okay, now, again, that does change at some point, and that's what the whole purpose of this course is about, is that I'm going to show you the little clues on the footprint chart, particularly when we start building the strategies. I'm going to show you all those little clues that give you the hint when, bang, the market's about to remove itself from a balanced state into a more imbalanced state. Okay, so with that being said then, if I was to then illustrate what a imbalanced market would be, it's a market that's trading on either the extreme point of the previous day or even outside of the previous day's range. Okay, now straight away, in balanced markets, the most important thing and the reason why imbalanced markets bring a lot of volume and volatility is because they are forcing participation. Okay, so what do we mean by that? Let's say the previous day, and I'm going to use the illustration of the bottom imbalance. Let's say the previous day that all the buyers were positioned somewhere around this price point. Now, if the market opens lower and opens out of balance, there's a lot of buyers that are now caught offside. Okay, so that by that very definition, those buyers have an option to do one of three things. They can either get out of those positions, in which case they sell, they can add to those positions, in which case they buy, or they can hold those positions, in which case they are neutral. But the very fact that prices are lower is going to force a decision, and that's the key. Now, if we look at it on the other side, sellers are also going to respond to the fact that prices are lower. So if sellers are also responding because maybe they want to enter shorts, maybe they want to add to shorts, by that very definition we can see that a lot of participants are being dragged in and being forced to participate at lower prices. Okay, and that's why when we have imbalanced markets, we will always see higher volume and higher volatility. Okay, so that's the basic interpretation of balanced and imbalanced markets. And again, the reason we go through this is because what you're going to find is that the strategies that are applicable to more balanced markets will be things like auction imbalance strategy and the failed break of the high and low strategy. Equally, strategies applicable to be imbalanced will be things like breakout trading and the initiative drive. In other words, as a rule of thumb, when markets are not in balance, we will tend to see the initiative drive strategy play out a lot better, as well as breakout trading play out a lot better. Okay, let's now move on to the next principle. Well, actually, let's have a look at a chart of a footprint balanced imbalanced. So as I said, very simply, we will just have the previous day's high and the previous day's low, and we can see that the market simply just oscillates between the high and the low. And again, note the amount of overlap, note the reluctance, note how often the market might show us a signal to move up, but then suddenly washes back down. Suddenly it sends a signal to be short, and suddenly it rotates the other way. Okay, a lot of chop, a lot of two-way trade, and a lot of lack of certainty in terms of direction. Okay, what you will also find, as you can see in terms of the delta or the delta day or the cumulative delta, is we do tend to see a relatively neutral delta throughout a balanced session, as you can see in the this looks like the pound versus the dollar. Okay. Let's look at another example now of what an imbalanced market looks like. So very simply, we can see the market opened up towards the top half. We then sort of sat on the top half all day, and eventually the market went for the breakout. Okay, and this is the key proponent, is that a market can sit in the top range of the previous day for some time, and then when the timing is right, when those signals get sent and the clues get sent, we then get the very decent breakout and obviously the extension and aggression to the upside. Okay, so that's just the basic understanding of a balanced and imbalanced market. Now, the next thing we're going to talk about is just general imbalances, but within the auction footprint. Okay, so remember we said the whole purpose of the footprint is we want to learn and understand the interaction taking place between buyers and sellers. Now, not only do you get a market that's trading in balance or balanced, but you also get within each individual rotation, you get an imbalance between the way buyers are executing and the way sellers are executing. Okay, so the interaction between buyers and sellers sometimes creates an imbalance. Okay, now that imbalance tends to get creative when either buyers or sellers become more assertive in their execution. Okay, so when they become more assertive, ultimately we need to know about that. So we want to highlight that for ourselves, okay? Because if all of a sudden a buyer is becoming a lot more aggressive and a buyer is stepping up the pace of purchases, we don't want to be, well, one, we don't want to be short, but also we want to make sure we're taking advantage of that shift in buying execution. Okay, now do note an imbalance, just very briefly, I'm going to go through it. We look diagonally on the ladder. I will obviously show you how to set up imbalances in Unit 4. And again, we will talk extensively about imbalances. I will show you the imbalance strategy a lot later on in the course. For now, however, just understand that an imbalance, we look diagonally on the chart. So, for instance, we look like that, or like that, or like that. And what we're looking for is we're looking for a very high relative difference between what a buyer is buying up here versus what a seller is selling down here. In other words, it's showing us when there's a sudden shift in the way the buyers are buying higher prices or the sellers are selling lower prices. Now, in terms of the chart, it gets reflected in color, as you can see on the chart. And again, I will show you how to set this up. But all we're looking at here now is as the market rotates higher, when we see an imbalance suddenly come in from buyers, okay, it's showing us that the buyers are stepping up or changing the manner in which they are executing. Okay, now, if buyers suddenly start changing the way they're executing, we need to be aware of that because it provides potential opportunities. Okay, don't worry too much about what those opportunities are, but in a basic sense, as a rule of thumb, you get an imbalance, you don't want to be fading it, you actually want to remain with the trend. Equally, once the market starts to fill into that imbalance, it then tends to fill it out, and we tend to see a little bit of two-way trade within that imbalance. Again, I will show you that a little bit of a later stage. In terms of where we see imbalances or why we see imbalances, note it comes from stops. Okay, so sometimes you get stops in the market, sometimes you get initiative from both buyers or sellers, all right, becoming more aggressive, and sometimes it can be just simply because of noise. Now, again, I will show you in the course how to differentiate between these three. Okay, now note just one last thing, imbalances do create very key markers. Okay, as I said, obviously, imbalances will show us if markets are moving quite aggressively higher, as in this example, the imbalances will show us that we want to remain with that trend. Okay, so it sets a key marker in the market. Equally, we know that that imbalance equals, a strong buy-side response. So by that nature, once that buy-side response is taken out, we do tend to get trade in the opposite direction. Okay. And that's why we mark them. That's why we utilize the footprint tool to find these types of imbalances. All right, and where we're going to apply this strategy is in the auction imbalance section of the course. Okay, now, market context, okay, again, something that not enough traders spend time on, but very simply, market context is nothing other than the nature of the market, okay? What is the nature of my market? Just like you look outside when you go to work in the morning, you say to yourself, well, what is the day like? Okay, is it going to be warm? Is it going to be cold? Is it going to be windy? Is it going to be sunny? Okay, and you make necessary adjustments. You take an umbrella, you take some shades, you take a jersey, or you don't, right? It's no different in the market. Yet we don't look at the market context enough. Okay, so what are some of the basic, proponents of market context? Well, first and foremost is volume. Okay, now you need to know what is your market doing at this point in time. Is it showing high volume? Is it showing low volume? Is it showing high volume at highs of days? Is it showing low volume at lows of days? Okay, so you need to analyze the market in terms of where volume is coming in. Then, flow dynamics. Okay, how's the market flowing? A lot of the time, we look at a market and there's one big green day or one big trend, and we assume the market just went in a straight line. Okay, but if you go and look at it and you actually go and drill it down and look at the footprints, it might be something like this, where the market rarely has a horrible trend. Okay, simply because the flow dynamics at that present time are not ideal. Right, then again, in terms of auction dynamics, very similar. How are buyers and sellers responding? In other words, is the market auctioning up and we get a bit of two-way trade and auctioning up and two-way trade and auctioning up? Or is it again just auctioning, deep retracement, auctioning, shallow retracement, auctioning, deep retracement, etc., etc.? Okay, so what are the auction dynamics like? How are the buyers and sellers auctioning with one another? Are we seeing initiative? Are we seeing responsive? Right? Then volatility. Okay, again, not something we've seen a great deal of, in 2017, but markets do open up sometimes. All right, now when markets are more volatile, some strategies are going to work better. Right, you're going to have to execute slightly different when there's volatility. On the flip side, when there's low volatility, we have to be more patient. All right, we can't afford to pay up in terms of prices, so we become more passive in our execution. Okay, now, the other thing we need to determine is, are our markets being driven by technicals, in which case, people are price sensitive, right? Or are they being driven by flow? Okay. Now, in flow dynamics, what we tend to see is the market doesn't really care much for technicals; it just tends to do whatever it wants. Okay. Or are they being driven by fundamentals? Okay, for markets being driven by fundamentals, you're going to see very trendy type moves and very aggressive type moves where the market's trying to reprice itself. Okay, so it's so important to be able to differentiate between, is the market driven by technicals, flows, or fundamentals? Right, then, is there trend or no trend in the market? And we know why that's important because we spoke about this principle a little bit earlier on. Okay, so where we're going to apply this concept of market context is throughout every single, one of these strategies that we're going to observe. Okay, now the next principle is high and low volume. Okay, something that's significantly important. Remember, it's not just high and low volume, it's relative high and low volume. Now, if you want to get good at this, you're going to have to start marking down certain things. In other words, every single day you need to say to yourself, in my market, what was the highest volume traded on a rotation? What was the lowest volume traded on a rotation? Now, where I find, the certain charts to be very useful is I like to use color lines. So let's say this was the volume histogram of the last couple of weeks, etc., etc. I like to put a nice marker at certain volumes so that I can see when a market is trading relatively high volume versus relatively low volume. Now, with the charting package, you obviously can do that. So again, it's important not just to understand what high and low volume is, but be able to know what relatively high and low volume is. Now, note, volume is a function of business activity, and most people don't know this, okay? Volume simply tells us there's more participation taking place. Now note, unfortunately, as a day trader and a speculative trader, we always tend to assume that all activity is speculative. Okay, it isn't. In fact, very little trade in the markets is speculative in nature. Most of it tends to be some form of hedge, some form of spread. Okay, so by that very definition, remember, someone who's speculating or speculative in nature, right, tends to be, very focused on price and manages risk very specifically. Equally, they execute very specifically compared to someone who's, say, less price sensitive or hedging. All right, they're just simply hedging out a position, so they're not too concerned about price. Now, one of the most important things to understand is where is it that business activity is taking place? In other words, where is the high and low volume coming in? Right? That's the important thing. And the most important thing is to say to yourself, why? Why is there high volume here? Why is there low volume here? Right? One of the things you're going to learn when we talk about breakout strategies is that what you need to see is I want to see high volume on the breakout. Why? Because high volume shows me a lot of participation. Now, by the definition of a breakout means that we're seeing not just buyers buying through highs, but we're also seeing sellers get out of their short positions. Okay? So if everyone is buying, there should be a high amount of business activity and we should see high volume. So if we don't, we've got to say why? Why? Alright, now as a rule of thumb, again a rule of thumb, high volume tends to accompany trend. Okay, low volume tends to accompany distribution. Now, one of the most important things is don't fade divergences. Okay, one of the again these hocus pocus things that they teach you in these very elementary courses is this idea of when there's divergence fade, i.e. markets are trending but they're trending on lower volume. Okay, now what I am going to say to you is a market is trending because it's trying to find price. Okay, it's in a discovery mode of finding price. Alright, now when a market is trying to find price, it can keep finding that price until such a point that someone is willing to sell it. Okay, and we don't know what that point is. Right, so we can't suddenly speculate that just because volume is going lower that it might be ready to turn around. Okay, so important, don't fade divergences, however, observe the outlier. Okay, so observe when that divergence exists, make a note of it, and I will show you at some point what you can look at on the footprint to trade these sorts of divergences. Okay, never fade flow. Okay, basic rule of thumb, we spoke about that in the trend principle. Don't fade the flows. Why? Because they tend to take a long time to turn around and can be very costly. Right, go with the flow. Now note, relative volume is paramount to interpretation. I've explained that. And in terms of where we're going to apply this, we're going to apply this everywhere. Okay, the principle of high and low volume is going to be applied throughout. Now, in terms of the basic example, I just want to show you the relative shifts. We can see really low volume here. As you can see, nice light colors showing us that relative low volume compared to the rest of the session. We then suddenly get quite a nice pickup, dark colors illustrating that real pickup in the change in delta. Equally, we can also see a relatively big pickup in terms of the volume. Now, in terms of relative, you can see that the shift is from 832 in this rotation to suddenly 1,893. So a real aggressive shift in the relative change of volume. Now, with that in mind, just keep note, okay? I showed you two types of footprint rotations. One is time-based, okay, and the other one is rotation-based. Now, so important, make a note of this. If you are setting your footprint charts to time-based, you can then look at these metrics on a relative basis. Why? Because you're comparing apple A with apple A. Okay. If these, however, are rotations, you cannot compare volume on a relative term. Why? Because you're comparing apple A with apple B. Okay, so important when you're dealing with rotations, the relative term of volume and delta isn't as important, whereas when you're referring to time, the relative changes are a lot more important. Okay, and again, as you'll see, I will explain to you and I will show you within each one of the strategies when's it better to use either a rotation or either a time, and you'll understand why it's better to use a rotation or time in the various strategies. Okay, now the next principle we're going to focus on is volatility. Again, volatility does not mean trend. Okay, that's the biggest mistake so many people make. It does not mean trend. Okay, volatility is simply a variation around a mean. So if that's my mean, my average price, volatility is just telling me that if this is what it normally does and it suddenly starts doing that, the market is now more volatile. Now, one of the greatest tools for that is Bollinger Bands. It shows us that shift in volatility. Okay, it doesn't give us a trade opportunity, it just shows us the market volatility has picked up. Okay, so like I said, volatility does not imply volume. Okay, so just because a market's more volatile doesn't mean there's going to be more volume. In theory, there should be. Why? Because like we said, when price moves very far from, or when prices break out and become imbalanced, then we should see a pickup in volume. So as a rule of thumb, okay, when we have volatility in an imbalanced market, okay, let me erase this. So when we have volatility in an imbalanced market, you're going to see a high amount of volume. When we have volatility in a balanced market, we can still see relatively low volume, okay, and that's the key. Where is that volatility occurring? And that's why we talk, or we spoke about the principle of, trade location or market context, okay? Because the context of the market is crucial to understanding where we could see volatility and where we could see higher or lower volume. Okay, so why does volatility occur? Well, it's very simple. The participation changes. Okay, so it's very simple. As a basic example, let's say it's 130 non-farm payrolls. We know it's a relatively large data piece. What happens? Well, the entire order book disappears. Okay, why? Well, because no one wants to take the risk. So the participation changing simply creates more volatility. Once the number comes out, obviously all those automated programs come in first. Then maybe we see the flows from the big institutions, and that's what's creating the volatility. It's the change in nature of participants coming in and out of the market. Okay, now obviously, we tend to see pick up in volatility when there's big risk events. We tend to see volatility when maybe markets move beyond certain price points. Okay, so again, it's so important to understand if a market breaks out of maybe a 5-year resistance point or high, of course there is potential for higher volatility. Why? Because the nature of participants are changing. Okay, now note the most important thing is to identify those potential triggers. Like I said to you, if we have a 5-year high, there is potential for a shift in volatility. So we want to be prepared for that shift and ultimately make sure that we apply the applicable strategies when we see that shift in volatility. Okay, some of the key places you will see pickups in volatility, obviously when we have key central bank decisions or key economic data, when markets gap open, either higher or lower, or when we see potential stop runs in various markets. Okay, Now, just to illustrate to you, a good example of volatility, this is the gold market quite recently, and what we can see is, we had a real good sell-off in the market. It sold off almost a good 50 ticks, and again, sucked in a lot of participants. We can see the volume picked up, the delta picked up, and more importantly, we had quite a strong positive delta on the day, reflecting maybe more buy-side positioning, and all of a sudden, the market just reversed on a dime, okay? Ultimately, we can see also, look at the number of imbalances here. Okay, lots of imbalances going through the market, when it was showing us potential for short side trades. Right? The market then obviously got or stopped out anyone short, maybe got a few people long, and then reversed in the opposite direction again. Okay, so real volatility, but note, this volatility doesn't occur outside of a range. It actually occurs in a relatively balanced market. Okay, so that's kind of why I wanted to show you this chart. Volatility doesn't necessarily have to come in the form of inside the previous day or in balanced markets. It can also be in balanced and imbalanced. Okay, next principle is initiative and responsive price action. So I'm going to go through this with you. I'm going to explain this again, and I'm going to talk about this in terms of obviously order flow dynamics. Okay, so order flow dynamics is simply just trend, volume, and delta. Now, initiative is where buyers or sellers step in and they initiate the price to move in one direction. Okay, why do they do this? Well, let's use a very practical example. Goldman Sachs, okay, they get an order early on a Monday morning, and some pension fund wants Goldman Sachs to execute 10,000 lots, okay? Now, Goldman Sachs has to execute that in the most efficient manner possible. Right now, one of two things can happen. Goldman Sachs enters the market, they begin the process of buying. Now, if someone is willing to sell and respond to Goldman Sachs, provide Goldman Sachs with liquidity, right, then what's likely to happen is the market is likely to buy until they find that liquidity, in which case we start to see the market move sideways. However, once that liquidity runs out, Goldman Sachs still has to finish that order, so they continue the process of buying. Okay, and again, they'll go in search and they'll keep buying until they find the necessary liquidity. Now, what can happen sometimes is those orders can simply be met straight away with the liquidity, and we get something like this. So we get the market coming up and it gets hit back down. Comes up, gets hit back down. Comes back, and so forth and so forth. Now, in this example, this is perfect for Goldman Sachs. Why? Because they're not having to move prices too far and they're getting their fill relatively easily. Sometimes, however, what happens is Goldman Sachs can't even get any liquidity and the markets very quickly navigate higher. Okay, and this is all it is. Initiative is just simply an order being initiated. The markets are initiating some sort of a move, whether that's an order, whether that's a break of a key level. It's initiative. Okay, buyers are taking the initiative to move prices higher, or sellers are taking the initiative to move prices lower. Now, as prices move up and down, people are going to respond to those prices, okay? And they're going to respond for a number of reasons. Maybe they feel it's discount or premium. Maybe they feel the market's gone too far. Maybe some short-term strategies. Maybe some hedging, okay? But as prices move, we get responsive type behavior. All right, now the three general types of price patterns you're going to see is the first one, initiative, responsive, initiative. The second is just simply responsive, responsive, and the third is initiative, initiative. Now, before I show it to you in the footprint, I'm just going to illustrate it for you. So initiative, responsive, initiative is simply initiative taken, the market responds to the higher price, and we initiate again and respond and initiate. Okay, that's the first type. The second type is responsive, responsive. So the market moves up, and simply we see response from sellers, moves down, we see response from buyers, moves up, moves down, moves up. Now, what's the difference between the first and the second? Well, in this example, what's happening is that as price is moving up, the buyers are backing out of those longs and selling, and equally the sellers are responding to the high. So the first thing is, as price comes up, we run into sellers who are responding, and then obviously the buyers take their profit and we move back down. Same thing happens when we get to the low. We first run into responsive buyers, and once those responsive buyers start to buy the market up, those sellers then to take profit, and the market moves back up, and so forth and so forth. So the nature of price action in terms of responsive, responsive is very different and unique to that of initiative, responsive, initiative. Now, the third type, which is one of the most aggressive, which is what I illustrated to you in the very strong V reversal or inverse V reversal, is where we get initiative taken and initiative in the opposite direction. Okay, or likewise initiative and initiative. Now, this is one of the strongest types of order flow price action you can see, and I will show you an example of this now in the next slide. Okay, so what we can see is obviously on the first slide here, we can see again a great deal of initiative taken. The market runs into that liquidity. Okay, so this is the initiative. We could see the market runs into that liquidity, and then straight away the sellers step it up and they sell back down. Okay, and we can see those sellers stepping it up. Why? Because initially we get the response from sellers. Okay, they absorb the market, and we can see obviously that very dark color scheming, and then the market starts to sell back down. Now note here, if you look at these couple of prices, look what the buyers are doing relative to the sellers. In other words, the sellers are selling a lot more than what the buyers are buying. Okay, and that's the key, is that we can see a great deal more initiative being taken from the sellers than being taken from the buyers. Now, you say to yourself, well, why are there so many buyers there? Well, it's very simple. When the markets come up such a long way in an initiative fashion, there's going to be a lot of shorts that are caught offside. Okay, so that very aggressive buying there, or bids being hit by the sellers, that's simply just what we call residual buyers. Okay, it's not necessarily people actually physically buying the market. Now, one of the most important things, and I will show you this a number of times in this V reversal, is this secondary section here. Okay, and this is the real clue to an initiative. So initially, the market comes up, it runs into responsive sellers. Those sellers initiate back down, but what we always see is we always get that residual first section, and then the key is once that residual section is done, we then get the second bit of initiative, and that's what you're seeing in that square block there. You can see how we're really seeing some initiative being taken from the sellers, and that initiative a lot of the time will also be seen as imbalances. Okay, so we'll see some real sell side imbalances coming when we get initiative taken from the sellers. Okay, now again, I'm going to illustrate this for you a lot more times, so don't worry. You will start to get the hang of it. Okay, so again, here's another very good example of initiative. And again, what we can see, market comes up nice and aggressively. The first thing we see is responsive type price action. So we can see right up here, real aggressive absorption. But note again, look at the left side versus the right side. Note how much more selling is taking place than buying. Okay, so we're seeing real initiative selling taking place at the high. Once that secondary buying is done, or in other words, they've been cleared out, notice what we get. We get real initiative being taken from the sellers. Again, notice how the sellers are hitting every one of the bids versus buyers doing absolutely nothing. Okay, and obviously in terms of price response, we get that very beautiful inverse V shape. Okay, now, in terms of just volume and all that, again, like I said, this is one of the highest volume principles you're going to see. We do tend to see a very large pickup in volume, but also we tend to see a large pickup in volume on the reverse side. Okay, that is the key to an initiative. It is initiative high volume in the one direction, and again in the opposite direction. Now, very traditionally and typically as a rule of thumb, any delta that accumulates on the way up will effectively unwind on the way down. Okay, now if we look at the right side example, this is more a bit of a sort of a responsive. So what we can see is the market comes down, we see lower prices being absorbed, market then extends a little bit, but again we just see a lot of absorption, a lot of two-way trade, someone accumulating the market. Once that accumulation's taken place, note we get a little bit of a pushback higher. The market runs into higher prices. We then get, again, the consolidation taking place at the high, a lot of absorption, and the market then begins responding to those higher prices. The market then obviously rotates back lower, and again we see those buyers responding at the lower prices. Okay, and that's the real key difference, is as the market comes down, we watch for that response being taken from We watch for the response being taken from, the buyers. They start passively buying the market. Once it starts to go back up, the sellers take profit, and that's what creates that rotation to the upside. Okay, so that's our basic, understanding of initiative and responsive price action. All right, now our last two little principles of this part A of Unit 3, high volume and low volume areas. Particularly important, and in terms of high volume, it's simple. It's large relative concentration of volume. Very simple. It's price areas with dark shades. Okay, so if I was to show you that on the chart, there's a high volume area, 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 there's a high volume area. Okay, now darker shades or darker, groupings of prices, the more dark and the more volume, the more relevant that high volume area is to other areas. Okay, so obviously we can see this is probably the most, the two most significant areas relative to, say, this example. Now, these are simply just high participation zones. Okay, remember we said volume equals business activity. Therefore, high volume areas are very high participation zones. Now, that's important, okay, because we always have to ask ourselves, why was there so much participation taking place at this point? Okay, what was it that brought the buyers and the sellers together to participate in this manner? Right? And those interaction points, we want to identify who's taken the liquidity and who's provided. Now, this is a really key thing to understand, okay? Remember, as markets are moving up, someone is a taker of liquidity and someone is a provider of liquidity, right? The taker is the person who's initiating, who's buying the market up. And as he's buying it up, whoever's on the offer, whether it's market makers, hedges, whatever it might be, they are providing the liquidity. So again, in terms of learning about positioning of markets and certain trade strategies, it's important to understand who is taking the liquidity and who is providing it. Okay? In instances where no one's providing it, that's when we're going to see principles like trending markets. Okay? In instances where there is, both people providing and people taking, that's where we're going to see more balanced consolidating type markets. Okay, so again, as we said, the net positioning and the delta in the market, that's quite important to understand. What you'll see is when we do get these high volume areas, as I suggested here, you always want to pay attention to what the delta is doing. Okay, why? Well, because as price is moving up here, if there's a high degree of volume taking place but price keeps moving up, we can see that there must be a lot more buyers than sellers taking place, and that's ultimately something we want to pay attention to. Okay, in terms of where we're going to apply the strategy, absorption and auctioning, hiding behind the elephant, as well as the footprint delta unwind. Okay, now our last strategy before we take a break, it's very simple. It's the low volume area. So this is low relative concentration of volume and the lighter shaded areas on the chart. Okay, effectively what these can be is footprint imbalances. So a lot of the time low volume shaded areas can be imbalances. Okay, now these are also low participation zones, and very simply no liquidity is being provided. Now the question is why? Okay, so as price is moving up and down, why is there no liquidity being provided? Okay, in the instance where maybe a market is trending and no liquidity is being provided, or maybe there stops, there's very good reason for that. Right? In balanced markets, we also need to ask, why is there no liquidity being provided? Now, remember, a lot of the time, low volume areas can be a result of stops or noise from algorithms, or it can be because of aggression in the execution. And again, we will go through these when we start to develop our strategies. Now, low volume areas act as key initiative zones as well as position unwind zones. And this is the key I'm going to show you, I'm going to illustrate to you. So as we can see in this rotation, we get quite a bit of initiative taking place. We can see a real low volume area, yeah, not much volume taking place, real aggression in the sell side from the sellers. And ultimately, this acts as a very key area. Why? Because this shows us where the positioning of the market has occurred. In other words, we can see the sellers have stepped up the selling around this price point, and by that definition, if it does come back above this price point, we can potentially see a bit of an unwind of those short positions. Okay, so where we'll apply this again in the initiative drive, the auction imbalances, and the footprint delta unwind. Okay, just another example there for you. Again, what we can, well, actually that's the exact same example, just made it a little bit bigger. So there you can see that low volume area, and obviously the prices sell off, and then that acts as a very good resistance area for the market. Okay, so this is the end of Unit 3 Part A. Now, I know this is an information overload. This was an hour video, hour and a bit video. So I know a lot of it might be, might seem a little bit too much. Take a break, okay? If this is all you do for today, that's fine. Take the break. Come back when you're refreshed and energized, okay? The principles is one of the most important units for you to understand before you start getting into the strategies, okay? So take your time. Now note, you're going to see these principles time and time and time again throughout the strategy section. Okay, so don't fuss too much. I'm going to go over them a lot in the strategy sections, units 6 to 15. And what I want to suggest is once you start seeing certain strategies that you like, they make sense to you, the risk profiling makes sense to you, come back and revisit the principles, okay? Because what you're going to find is that as you begin to understand the strategies, you're going to start to understand the key principles behind that strategy, okay? So and then most important, guys, you can revisit this unit, okay? So don't worry about it. You can revisit this on your first rest day, which will be day 7 of 30. Okay, go take a break, and I'll see you guys again for part B.